Hey everyone, and welcome to The Explainer. What if I told you that a couple of huge government policies, one in the US and one over in Europe, have basically fired the starting gun on one of the biggest economic shifts of our generation? Well, today that's exactly what we're diving into: green investing. We are literally building a roadmap for you, the investor, looking at 2026, which is shaping up to be this massive turning point for the whole sector. If you want to stay ahead of these kinds of role-shaping trends, do me a favor and hit that subscribe button right now. Okay, let's jump in. So let's kick things off with a number that just kind of sets the stage. $2.1 trillion. That's how much was invested globally into the low-carbon energy transition in 2024 alone. I mean, to put that into perspective, that is more than the entire GDP of a country like Canada. This is not some small niche market we're talking about. This is a colossal, undeniable wave of capital. It confirms that the green transition isn't just a side project for companies anymore. It is now a core part of their economic and profit strategy. And that right there is the most important thing to get your head around. We are way past the point of thinking about green investing as just, a nice thing to do. This is now about finding long-term profitability, it's about stability, and it's about resilience in a world that is changing incredibly fast. It's about spotting the companies and the technologies that aren't just going to survive this shift, but are actually going to lead it. And 2026, well, that year is really poppin' as a moment where all these trends come together into some huge opportunities. To help you navigate all of this, we've laid out a really clear roadmap for this explainer. First, we're going to tackle why 2026 is such a big deal. Then we'll get our definitions straight so we're all speaking the same language. We're going to master the ESG framework as an analytical tool. After that, we get to the fun part: 7 really high-conviction investment ideas. And finally, we're going to get real and talk about profit, risk, and the sometimes messy reality of investing in this space. All right, so let's dive right in. Why 2026? What is it about this specific year that acts as the starting gun for this next big phase of the green economy? Well, the short answer is policy. But we're not talking about small-time regulations. We are talking about massive, continent-spanning government programs that are now really starting to sink their teeth into the economy, creating this incredible tailwind for green investment. And, frankly, a lot of pressure on anyone who doesn't get on board. Now, what's so fascinating here is you can see the two giant engines driving this whole thing. Over in the United States, you've got the Inflation Reduction Act, or the IRA. And let me tell you, this isn't some gentle nudge. This is a fire hose of money being sprayed at the problem in the form of tax credits. It offers these long-term, predictable credits for producing renewable energy, which completely changes the math for building huge solar farms, wind farms, and energy storage projects. It de-risks the financing, making these projects feel more like stable utilities, and that's attracting a flood of serious institutional money. Now, on the other side of the pond, the European Union is using a totally different tactic with its Carbon Border Adjustment Mechanism, or CBAM. Think of it as a carbon tax at the border. If a company from another country wants to sell, say, steel or cement in Europe, they now have to pay for the carbon they emitted to make it. If the process is dirty, they pay a tariff. This puts incredible pressure on global supply chains to clean up their act or else lose access to one of the biggest markets in the world. So you've got this American carrot and this European stick, and together it's this powerful 1-2 punch that is fundamentally reshaping how global business is done. Okay, so before we can get into the nitty-gritty of specific investments, we've got to make sure we're all speaking the same language. The green landscape is filled with all these terms that sound kind of similar and can get confusing. But if you want to map the territory, you need to know what they mean. So let's quickly break down the 3 big ones you absolutely have to know. First up, you have clean tech. You can think of clean tech as the what. It's the actual stuff, the technology, the innovation. This is a massive umbrella that covers everything from the next generation of solar panels and wind turbines to new fuels like green hydrogen, to systems that reduce waste, all the way to tech that makes our buildings more efficient. It's really the hardware and software of the green transition. Next, there's green finance. So if clean tech is the what, green finance is the how. It's the money. It's the financial engine that makes all that technology possible. We're talking about the financial products themselves, things like green bonds, which are used to raise money for specific environmental projects. Or it could be venture capital funds that are only investing in clean tech startups. Or the financing that's building out those huge EV charging networks you see everywhere. It's literally the plumbing of the green economy. And finally, we have ESG investing. Now, this one is the broadest of the 3, and it's best to think of it as a framework for analysis. ESG stands for environmental, social, and governance. It's a lens that investors use to look at companies, and it's not just about their direct environmental impact. It's about how well they manage a whole bunch of long-term risks, everything from their labor practices to how they protect customer data to the quality of their board of directors. It's really a way of judging a company's overall resilience and how well it's managed. So let's really dig into that for a second. Mastering the ESG framework is kind of like learning the rules of the road for investing today. And it is so important to understand that ESG, at its core, is not a moral filter. It's a sophisticated, data-driven tool that smart investors use to size up long-term financial risk and get a sense of a company's stability and its ability to adapt in this changing world. This breaks it down perfectly into the three pillars. The E for environmental is the obvious one, right? It looks at a company's carbon footprint, its pollution, how it uses resources. For you as an investor, why does this matter? Well, a company with a good E-score is way less likely to get slapped with huge government fines or to find out that its billion-dollar factory is now a worthless, stranded asset. Then you have S for social. This is all about relationships with its employees, its suppliers, its community. Think about a clothing company. If it gets exposed for using terrible labor practices in its supply chain, the reputational damage can be catastrophic and absolutely crush its stock price. And finally, there's G for governance. This is all about how the company is actually run. Is the board effective? Is executive pay out of control? Are there strong anti-corruption policies? A company with weak governance is a risky bet, while strong governance ensures management is looking out for its shareholders over the long haul. So how do we actually measure all this stuff? Well, there are specialized rating agencies like MSCI and Sustainalytics that crunch enormous amounts of data to spit out ESG scores. These ratings, like MSCI's scale that goes from AAA down to CCC, are designed to give you a snapshot of a company's resilience to those long-term risks. They're even getting super advanced with metrics like implied temperature rise, which basically projects a company's carbon emissions and tells you what level of global warming we'd get if every company acted like them. It's a pretty wild way to see who's serious about climate goals. But, and this is so important, all these agencies have their own secret sauce, their own proprietary methods. A smart investor never, ever relies on just one score. You have to compare a few different sources to really get the full picture. For anyone out there who's just getting started, here is a super simple 4-step roadmap. First, just figure out what you care about most. Is it cutting carbon? Is it clean water? Define your values. Second, set your financial goals. Your risk tolerance, your timeline. Third, pick your investments. And for beginners, a fantastic place to start is with broadly diversified exchange-traded funds, or ETFs. An ETF is basically a basket of stocks you can buy as a single share, so you get instant diversification. Something like ESGU gives you the whole market but screened for ESG, while an ETF like ICLN is laser-focused on just the clean energy sector. And finally, step 4, just pull the trigger and then monitor how it's doing over time. Okay, so now that we've got our framework and our definitions down, let's get to the real meat of this explainer, identifying the actual destinations on our investment roadmap. Based on those huge policy drivers we talked about and the real-world needs of the economy, we've zeroed in on 7 high-conviction investment themes that look really promising for 2026 and beyond. All right, this is the core of it all. Let's walk through these. Number 1, clean power. This is the foundation. With the IRA tax credits basically guaranteeing revenue, building huge solar and wind farms is becoming a super stable, attractive investment. Number 2, energy storage. I can't stress this one enough. This is the linchpin. You can have all the renewable energy in the world, but if you can't store it for when the sun isn't shining or the wind isn't blowing, the grid doesn't work. We're expecting a massive surge in deployment in 2026. This is a huge area of growth. 3, next-gen mobility. We're looking beyond just the electric cars themselves to the tech that will make them better, specifically solid-state batteries. They promise longer range and faster charging, and car companies are pouring billions into them. Number 4 is green hydrogen. This is more of a long-term play, but it's essential for cleaning up heavy industries. Governments are creating these hydrogen hubs to kickstart the market. 5 is carbon capture. For industries like cement that can't just switch to electricity, this technology is becoming a must-have, especially with things like the EU's carbon tariff. Number 6, sustainable agriculture. How we grow food matters. Regenerative farming practices and technologies that make supply chains more transparent are seeing huge consumer demand. And finally, let's talk about number 7, green fintech. This one is fascinating. As this whole green economy grows, you need the digital plumbing to run it. Think about AI platforms that automate all the complex paperwork for green financing or track carbon data for companies. Investing in these fintech players is like owning the toll road on the green economy highway. They make money off all the activity and complexity. Okay, we've laid out the opportunities, and that's always the exciting part. But let's be real, investing is never a straight line up. So for this last section, we need to have a very honest, clear-eyed conversation about profits, performance, and the very real hazards you have to navigate when you're investing in the green sector. So there's always this big debate. Do green investments actually perform better? And the answer, well, it's complicated. Yes, a lot of funds focused on climate have had fantastic returns, but a lot of that performance comes from something called sectoral tilt. Basically, these funds tend to be packed with high-growth tech stocks, think about Tesla or Nvidia, which have just been on an absolute tear for lots of reasons. The real, maybe less glamorous, long-term value of green investing is on the right side of this slide: risk mitigation. Sustainable companies tend to be more efficient, using less energy and water, which saves them money. But more importantly, they are better at avoiding massive fines, and they can often borrow money more cheaply through things like green bonds. So while a tech boom might give you a short-term pop, the real financial superpower of green investing is long-term resilience. And of course, there are major risks to watch out for. Government policy is a huge tailwind right now, but it can also change, creating uncertainty. A lot of the exciting tech, like those advanced batteries, is still pretty early stage, which comes with its own set of risks. And there are real-world operational challenges, like being dependent on the weather or supply chain bottlenecks for critical minerals. But honestly, the most dangerous, most insidious risk of all is greenwashing. And if you think that's just an exaggeration, check this out. A recent investigation of European investment funds, funds that were specifically marketed and sold to regular people as green, found they held billions of euros in major oil and gas companies. And not just any oil and gas companies, but ones with plans to aggressively expand fossil fuel production. I mean, that is the literal definition of greenwashing, and it is a huge trap for investors who are just trying to do the right thing by trusting the label on the fund. So, how in the world do you protect yourself from this? Well, you have to become a bit of a detective. You have to be skeptical. First, always scrutinize the holdings. Look past the catchy name of the fund and see what companies it actually owns. You would be shocked at what you find. Second, use those detailed third-party risk reports we talked about to see what the fund manager might be hiding. And third, start demanding data assurance. Because of policies like CBAM, having your emissions data verified by an auditor is becoming the new gold standard. Companies that do this are showing they're serious, and they're probably a safer bet. All of this really leads us to one of the oldest, wisest principles in all of investing. When you consider all the risks, the policy changes, the tech that might not pan out, the threat of greenwashing, your single most powerful weapon for building resilience is diversification. Don't put all your eggs in one basket. Don't bet on just one technology or one company or even just one country's policy. By spreading your investments across different green sectors and across different parts of the world, like both the US and Europe, you can ride out the bumps and dramatically lower your risk. So, to wrap this all up, here are our key recommendations for anyone looking at this space in 2026. First, focus on the big infrastructure projects that have solid government backing, like utility-scale solar and energy storage. Second, target those enabling toll road technologies, like green fintech, that benefit from the entire ecosystem's growth. Third, use ESG scores primarily as a smart tool for managing risk and finding well-run companies. And finally, and most importantly, practice deep due diligence. Always look under the hood to avoid getting burned by greenwashing. Look, the transition to a green economy, it's not a question of if anymore. It's happening. The money is moving, the policies are locked in, and the technology is getting better every single day. This is no longer a niche trend. This is the future direction of the global economy. So the only real question left is the one you see on the screen. Where will you find your opportunity? I really hope this roadmap has given you a much clearer picture of the landscape ahead. Thank you so much for joining us here on The Explainer. If you got value from this deep dive, make sure you're subscribed to the channel. We'll see you in the next one.